Hello everybody, welcome back to my channel. It's me. So if this is your first time here, welcome. And in today's episode, we are going to talk about long-term investing versus short-term investing. So which one is actually smarter? We're going to take a deep dive into both of these strategies and discuss how they work. Okay, so let's start with the long-term investor strategy. This is when an investor holds on to their stocks for more than 1 year. It means that they are not active traders, meaning that they do not buy and sell frequently. In fact, they might only do it once or twice per year. They also don't react to day-to-day price fluctuations. Instead, they focus on the business fundamentals of the company. So things like their revenue, their profit margins, their cash flow, and so on. These investors will buy stocks that they believe in for the long run. They're prepared to hold on to them for several years, even if there are some temporary setbacks. They don't panic sell because of short-term losses. They understand that sometimes it can take a little bit longer before a stock reaches its full potential. The goal of the long-term investor is to generate long-term growth by building a well-diversified portfolio. They often use dollar-cost averaging, DCA, as their investment strategy, which means that they invest a fixed amount of money at regular intervals, regardless of the current stock prices. This way, they buy more shares when the stock price is low and fewer shares when the stock price is high. By doing so, they reduce the impact of market volatility and increase their chances of getting better returns over time. A good example of a long-term investor would be Warren Buffett, who is famous for his long-term investment strategy. He focuses on buying stocks that he believes in for the long run, and he does and panic sell when the stock prices go down. Now, what about the short-term investor? Well, short-term investors hold on to their stocks for less than a year. They tend to be more active traders, and they focus on making quick profits. Unlike long-term investors, short-term investors don't really care about the business fundamentals of a company. Instead, they focus on things like recent news, economic data, and market sentiment. They want to take advantage of short-term price movements, and they are willing to take risks to do so. So they often buy and sell frequently, and they use strategies like day trading and swing trading to try to make profits. Now, a lot of people say that short-term trading is gambling and not investing. But is that really true? Let's take a look at some examples. If someone buys a stock today and sells it tomorrow, just because the stock price went up a few percentage points, then yeah, that is probably gambling. But what if someone buys a stock today and waits a week until the earnings report comes out before deciding whether to keep the stock or sell it? That person is now using some information that wasn't available when they bought the stock. So technically they are now investing and not just gambling. So basically what I'm trying to say is that it depends on your strategy. If you simply buy a stock and sell it immediately after a few minutes or hours, then yes, you are probably just gambling and not investing. But if you buy a stock and use new information that comes out to decide whether to keep it or sell it, then you are actually investing. You are actually trying to value the stock based on new information that was not available before. So in this case, it is not really gambling. And actually, short-term traders can outperform long-term traders by doing so. So is short-term trading smarter than long-term investing? Well, it can be, but it is definitely riskier. When you trade short-term, you have to pay attention to the markets every day. You need to be prepared to buy and sell at a moment's notice. And you also need to be able to handle the emotional pressure that comes with trading. On the other hand, long-term investing is much more relaxed. You don't have to pay attention to the markets every day. You can just buy and hold for many years without worrying about short-term fluctuations. Long-term investing is also less risky. When you buy and hold for many years, you are able to ride out any short-term volatility and take advantage of long-term growth. Basically, there is no clear winner here. It really depends on your personality and your goals. If you're the type of person who likes to be in control and you want to actively manage your investments, then short-term trading might be a good fit for you. But if you are the type of person who wants to invest and then forget, then long-term investing is probably a better option. So, which approach is better for beginners? The answer is long-term investing. It is much easier to buy and hold for the long run than to try to actively trade in the short term. If you are a beginner, you should focus on learning the basics of investing, such as how to analyze a company's financial statements and how to value a stock. Once you have learned the basics, you can start buying and holding for the long run. You can also consider using a robo-advisor. If you want some help managing your portfolio, a robo-advisor is a great tool for beginners because it automates the investment process. You just have to answer a few questions about your goals and risk tolerance, and the robo-advisor will build a portfolio for you. Some popular robo-advisors include Betterment, Wealthfront, and Vanguard's robo-advisor. All of these options are low cost and easy to use. But wait, I promised you that I would talk about something that most people don't know. So what is that? Here's a secret that most people don't know. Most people don't know that you can actually combine long-term investing with short-term trading. This can be very beneficial because it allows you to take advantage of both long-term growth and short-term volatility. For example, you can buy and hold a stock for the long run, while also day trading small positions for short-term profits. This can be a great way to supplement your income and potentially beat the market. There are two ways to do this. First, you can have a long-term portfolio that you never touch and then use a separate account for short-term trading. Or second, you can have a long-term portfolio and day trade small positions within that same portfolio. The key is to keep your long-term portfolio separate from your short-term trading account so that you do unrisk your long-term gains. With this approach, you can enjoy the benefits of both long-term investing and short-term trading. You can get the potential for long-term growth while also generating income through short-term trading. This can be a great way to maximize your profits and achieve your financial goals. However, it is important to note that this approach is not for everyone. It requires a certain level of experience and knowledge to be successful. You need to be comfortable with both long-term investing and short-term trading. And you need to have a solid understanding of the markets. Additionally, you need to be disciplined and have a plan in place to avoid making impulsive decisions. If you are not prepared to follow this approach, it is best to stick with long-term investing or short-term trading separately. So which one is smarter, long-term or short-term? Well, the truth is that both approaches have their pros and cons. There is no clear winner. It really depends on your personality and your goals. However, if you are a beginner, I recommend starting with long-term investing. Buy and hold for the long run and then use a robo-advisor if you want some help managing your portfolio. You can also consider combining long-term investing with short-term trading. This can be very beneficial because it allows you to take advantage of both long-term growth and short-term volatility. However, this approach is not for everyone, and it requires a certain level of experience and knowledge to be successful. I hope that you enjoyed this video and that you learned something new. If you did, please give this video a thumbs up and share it with your friends. And if you haven't already, please subscribe to the channel. Thank you so much for watching, and until next time, happy investing.